Should we buy or sell the 7 to 10 year Treasury Bond ETF? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So let's go to the ETF. 1.57% away from the 52-week low, minus 18% away from the highs. When it comes to these bonds ETFs, you could of course short them, but I think that the nature of these ETFs is that if you want to express shorting, I think there's just better ways to do it than to short treasury bonds. That's why I primarily look for long opportunities in these kinds of bond ETFs, because of how they correlate with other indexes. Just as a general rule, when you have short candlesticks in a succession or even singly, that is when the market is very prepared and has a common understanding of events. And that both for candlestick that are green and also red. When you have these very tall candlesticks like back here, that is when the market was very confused, and it became very confused here. And so those are times of volatility where the big players in the market are very puzzled. These recent candlesticks are on the higher end of the spectrum. So it shows us that the market participants are very puzzled about what the interest rates means for the bond market, longer term and also short term. What is interesting now, let me just draw it in. If we look here at previous times where we have had counter trend rallies in the bond market, if you look here at the wicks here, they look similar to the wick we see here. And we do have some of that kind of wick behavior now as well, where you see that so the wick is like the thin line that goes down here. And it shows us that when we close higher, significantly higher than the wick, that there is some kind of buying pressure. Back here, we did have a counter trend rally in the bond market, so it was a time where it made sense to be bullish on bonds temporarily. Back here as well, we didn't get huge rallies, but we did get some rallies. So it's just a question of like pattern recognition. We have seen this in the past, and in the past it was bullish. Here are the daily data points. We have reclaimed the 5-day moving average. Not the most impressive bullish move, but it is a bullish move nonetheless. We are using it as a support. Looking here at RSI and the PPO. If you look here at the purple 20-week PPO here, previous times we have had these readings like back here in 2016, 2017. We did have a counter trend rally. We did definitively go lower later, but it wasn't like a too bad of a time to turn bullish. Back here, during 2013, we did eventually form a bit of a double bottom, and we did have a strong rally for the treasury bonds. Looking at the daily data points, accumulation distribution shows us that the bears are definitively still in control. Looking at RSI and the PPOs, we are at levels that have formed lows in the past. Given that quite a few of these bullish opportunities have not really worked out for the bonds, I will give the bulls a 2 here. They just have so much to prove, but we are oversold, and we do have that very interesting candlestick wick pattern. So the conditions are here for a bit of a mean reversion. Let's look at the seasonality. So to the right, we do see that there is some kind of bullishness into mid-ish October, but then it gets weak into late November, then it gets strong. To the left, over the last 5 years, October is a weak month, November is very strong. The last 10 years, October is the second weakest. Well, no, worse. It is the weakest month. That's obviously not exactly bullish. November is stronger, but overall November is bearish. The last 20 years, we do see that October is the #1 weakest month for this ETF. November, however, paradoxically, is the third strongest month. Given that this is the 1st of October, the October seasonality is a pretty big deal for us now. So even though November is interesting, I must give this one to the Bears. I think I will have to give the Bears a -6 here. It really is, well, I think I will have to upgrade it to -7. Bad seasonality, frankly. Let's look at the fundamentals. So now I am comparing the BNDX, which is, the big picture. Let's get the name. It's the total international bond ETF, and the IEF, of course, the one we have in focus. Looking at year-to-date performance, IEF is underperforming global. Looking at yield is slightly higher on the BNDX. But none of these are really good if you want yield. Here we can see some France, Italy, Spain, Germany. Yeah, diversified. Here is US, of course, focused. Ideally, we would like to have more data here on credit quality and all of that, maturity, but it might be that I don't get the data because I don't have the pro version. I'm not sure, but yeah, getting that kind of data would be beneficial. On the fundamentals, I will give a 4 in favor of the bulls here. If you want to get into bond ETFs, it makes more sense to go for this one than the BNDX. So let's look at some correlations. Long-term -35% with the S&P 500, 88% positive with the BNDX, 98% with TLT, which is the 20-year Treasury Bond ETF, -100% with the 10-year yield. Daily data points, 69% with S&P 500, and that is positive, so they do not move as inverse as they sometimes do. If you look back here as an example, during this period there is -86% correlation, which means that they had during this downtrend they had a bit of an inverse effect. Okay, so here is 96% with the BNDX, 97% here with the TLT, and an almost perfect negative correlation with the 10-year Treasury Bond ETF. But no. An almost -100% negative correlation with the 10-year yield. Okay, so US 10-year yield. So the 10-year yield and the IEF, they naturally move opposite each other. But that doesn't mean that we know what is going to happen with the 10-year yield. That is a moving thing. It's an ongoing process. If everyone knew it, it would have been very easy to it would basically be like printing money, trading the IEF. But that is not the reality of the situation. Because if it was that easy to just be like, if it was that easy to know what the 10-year yield is going to do, then you would have a bunch of hedge funds crushing the market simply by betting on the 10-year yield. The reason why they don't do that, and we don't have a bunch of hedge funds crushing the market, is because it's very difficult to actually know what is going to happen with the 10-year yield. And yeah. So we did see that there was a very clear correlation with the TLT, which is the 20-year Treasury Bond ETF. Here is the TLT. Massive sell-off, massive. You see here again, we have these very tall candlesticks, which is a sign that many participants are very erratic here, not really sure what to do. There is chaos in the market. We have gone down to this key low from 2013, 2014, looking at RSI, very low, PPO, very low indeed. Looking at the daily data points, we see something similar. Here we are comparing the IEF with the TLT. We see that the IEF has massively outperformed the TLT now. Looking at RSI here, we are in a range that is rare. We usually do not see that 7 to 10-year Treasury bonds outperform the 20-year this much. We usually actually see some mean reversion after this strong of a performance. Let's look a bit here at time cycles. There are some time cycles here as an example, suggesting that we could have a bit of a declining phase, meaning that the IEF is likely to underperform the TLT. Let's look a bit at the seasonality, like that. And yes, we do see here that the IEF has a tendency to underperform the TLT into, quite far into the future. So I give a -4 to the bears on relative performance. The interesting thing we saw here was the relationship between the IEF and the TLT. We do end up with a -1.3 in favor of the bears. We are, however, oversold, and we did have a candlestick wick pattern that previously led to some bounces for this ETF. The seasonality, however, is atrocious. So there's that. So some mixed messages here, some bulls, some bears, but overall, I do prefer to look for bullish opportunities for bonds, simply due to the correlations with other assets. Given that we have some time left, I think we can look at some alternatives to these ETFs. There are you do have high yield corporate bonds, also called junk bonds. We have seen massive deterioration here as well. You see here that during the global financial crisis, these crashed completely, late into 2008, but they actually started to recover before the market. Given that we are now approaching levels we saw back during the C-19 lockdown, it shows us that there is tremendous pessimism here about the future of the stock market. Another bond ETF is the investment grade corporate bond ETF. So investment grade bonds, they are better, higher quality, but here again we are way below. This is worse. We are below the 2020 lows. We are, this is not good. This is not health at all. And here you can see, if you look here on the candlesticks, you have like a gap here as well. And gaps happen when the market is just shocked. Really, it just couldn't handle the difference from one week to another, and it just opened below. There is this saying among technicians, technical analysts, that gaps are filled, but you certainly cannot have an investing strategy based on filling gaps. Gaps are sometimes filled. Gaps can take a long time to fill. There's been gaps that have taken decades to fill. So this idea that the gaps must be filled, it's just a goofy idea. And when it comes to a lot of assets, well, quite a few of the main assets like commodities, bonds, and stock market indexes, you must be aware that there are futures and they trade in a lot more than the ETFs. Hence, you might have a price gap on the ETF, but that doesn't mean that there is a price gap on the futures. So there actually has been price exploration on the futures. So that is just something to be aware of. And you also now have numerous ETFs that as an example, on TD Ameritrade, they do trade in like 20, like all day, which means that even on the ETFs, there is actually full price exploration. So this phenomenon of gaps being filled, it could, because of that constant price exploration happening now, it's not a phenomenon that necessarily will continue going forward. And even back in the day, before futures, before electronic trading, betting on gaps being filled was definitively not a good strategy. So whatever you do, of course, you do want to be market neutral. One of the ways to be market neutral is to look for bullish opportunities in bonds due to the correlations with other assets. I do prefer to build a more market neutral portfolio. where none of the assets are really too strongly correlated with each other, so they sort of offset each other, and that's pretty nice to have, especially in the current market condition where it's very chaotic. Whatever you do, of course, you do want to go to diamondarm.com to get more intel, and stay tuned for more.